Welcome to Retiring Well, where it's our job to help you enjoy financial security in any economy. We've got a great show lined up for you this week. We're talking about your secret weapon to managing volatile markets. I know you're going to enjoy it. But before we jump in, of course, we want to do the same thing we do every week, which is introduce you to your retirement planning specialist.
Hi, I'm Rob Russell.
And I'm Curve Miller.
And we are from Russell & Company,
Southwest Ohio's total wealth management firm,
helping you rescue your retirement from bad advice.
Retiring well, providing financial security in any economy. Today is the day you can take control of your financial future and eliminate worry about your money forever. Retiring well, featuring retirement planning specialists Robert Russell and Curvin Miller of Russell & Company in Dayton, Ohio.
All right, what is your secret weapon to protecting yourself against volatile markets? I know you want to know what it is, and I can't wait to share it with you, but of course I just can't come right out and tell you. First, we've got to go through some information here first. So, I want you to be aware of something out there called the Hindenburg Omen. Now, doesn't that sound scary, the Hindenburg Omen? Well, here I have this article from CNBC, and I got to tell you something. I've been in the financial industry for 18 plus years, and I have never heard of this thing called the Hindenburg Omen until this past year, and I'm now seeing a reference 3 or 4 different times. And what that Hindenburg Omen, what it really refers to is it's a specific charting technique that technical analysts see. So it's when charts look a certain way, they call it the Hindenburg Omen. And it basically means, oh my goodness, stocks are about to crash. So here we go from CNBC. The title of the article, Hindenburg Omen looms over the S&P 500. And it says, a technical analysis pattern that's for stock traders that has pointed to an impending crash in stocks, adding to an increasing chorus of voices that have turned bullish over equities over the second half of the year. The Hindenburg Omen, dun dun dun, is named after the Hindenburg disaster in 1937. This particular set of charting analysis, the reason we pay attention to it is apparently it has correctly predicted all of the biggest declines in the stock market over the last 30 years, including 2008. Now, it's funny, I never read about it before the 2008 crash, but apparently it predicted it here. And they're just talking about how our current bull market's overstretched, the global markets are starting to feel the effects. Basically, what's happening is we now have the technical people saying, we're really worried that markets are going to crash soon. Well, maybe they will, maybe they won't. The question I have for you, though, is how are you protecting yourself if they do? Well, that's where your secret weapon comes in. Time to announce that secret weapon. Well, I'll tell you what it is. It's really nothing more than having insured income for life. Now, I want you to think about this. Retirement planning. It's all about living day to day, Monday, Tuesday, Wednesday, Thursday, Friday, Saturday, Sunday. Retirement planning is about making sure that you have sufficient income coming in day to day so that you can live a comfortable and stress-free retirement. That's what it's about. Well, if you can insure those income streams so that you know for as long as you live that money's coming in, well, then you're going to be in great shape. And I'll tell you what, even today, there are ways to do it where if you're retired, we're seeing retirees enjoying 5-6% income for life. We're seeing those that are retiring, in the next several years. We're seeing them put money into accounts where it's generating huge income for them when they choose to retire. This is a great area to ask your retirement planning specialist about. And folks, that brings up our one thing. This week's one thing is very simple. Insured income is the king of your retirement. If you have insured income, you just don't care what markets do because you know your money's there each and every month. That's super important. All right. Now, I want to turn things over to your retirement planning specialist because they're going to talk about more on this topic of insuring your income, how they go about doing it, how they help people just like you, with their retirement planning to make sure that they can build that rock-solid retirement income plan.
Ah, the fiendish Hindenburg omen. Well, one of many different technical indicators like the Golden Cross and the Death Cross and all these different ways to look at the markets or at stocks and try to make an educated guess and forecast what's going to happen. And here's the truth, none of them work all the time. While you can decipher some value out of them, as humans, we tend to look for patterns in charts and technical analysis and try to give us a reason, a story why we should buy into the market or sell into the market. I've got an omen for you. At some point in the future, the market's going to crash. At some point it will, and it tends to happen when you want your money out. So the key is, and the reason even to talk about this subject is that you could have too much at risk in something you can't control.
That's right. Anything can happen at any time. It's an excellent point. And what took you a whole lifetime to save, you can't have a mistake saying, I wish I would have taken some of the risk off the table, especially if you're nearing retirement. That's the thing is, why did you save that money? Was it to support a pension? Was it to support Social Security or supplement these income streams? And the thing is if the Hindenburg omen is correct, or if anything, or if a war in the Middle East breaks out, the markets go up and down due to forces that are outside of your control, outside of the control of your advisor. So what you need to do is make sure you understand your capacity for risk, especially if you're nearing retirement or in retirement, because your risk tolerance does change as you get closer to retirement.
Oh, it definitely should. Unfortunately, a lot of people and advisors and money managers throughout the land, they miscalculate risk. They're mistaken. Their math is just flat wrong. And they're looking at risk in the old way. I have bond funds, I have stock funds, and I'm balanced. I balance my risk. That's baloney. The truth is you need to stress test your portfolio so if this Hindenburg omen or the next series of omens are right, that you are protected, that you're in a position of control and comfort, especially when it comes to your income in retirement. If you're planning on retiring, or maybe you are retired and you're living off of what you saved, the last thing you want to do is take on too much risk and subject your life savings, your lifestyle, to something that you have no control over. And that's why we built this stress testing for your portfolio.
If you want to have your portfolio stress tested, give the number on the bottom of the screen a call. One of the wealth advisors at Russell & Company can help you there. But also, before you do that, think about your why. Why do you invest the way that you do? There's thousands of investments. There's thousands of stocks. There's thousands of a lot of things. But there's only one reason of why you'd put your money there. You got to know that. Is it for income? Is it to give it away to charity? What is it? And once you know why you invested a certain way, you'll start sleeping a little bit better at night, because then you can match your personal goals with your financial goals. So again, to have your portfolio stress tested by a wealth advisor at Russell & Company, give the number at the bottom of the screen a call.
Thanks. That was terrific information. And folks, I believe that you deserve a rock-solid retirement income plan. And here's your opportunity to get it. You can talk to these guys absolutely free, no obligation. Just pick up the phone, call the number on the screen. Make that connection. It's important. Think about the consequences if you miss out on that opportunity. All right, time to turn the page a little bit. It's time for trivia. This week's trivia question has to do with interest rates. We all remember the 70s and the 80s when interest rates were really high. Well, they peaked September 30th, 1981. And on that day, you could put your money in a 10-year government bond, and the government for the next 10 years would pay you a certain interest rate guaranteed. What was that interest rate? Was it A, 14.65%, B, 16.47%, C, 17.21%, or D, 15.84%? The answer will be at the end of the show. Hi, my name's Michael Reese. I'm a certified financial planner who specializes in retirement planning. And for the last 18 years, I've been helping my clients enjoy financial security during their retirement years. And one of the hottest financial tools out there right now for retirement planning are annuities, but they're also the most misunderstood. And it's really no surprise why things are so confusing, because both the insurance companies and the financial media do such a poor job explaining what annuities are and when they should best be used. That's why I've created a series of videos absolutely free that you can watch in the comfort of your own home to teach you what annuities are and how they work.
Visit www.makingannuitiessimple.com today for a free video series with TV host and retirement planning strategist Michael Reese.
You're on the back nine heading for the clubhouse. Your dreams of spending time with family and enjoying retirement are just within reach. What happens if you end up in the rough? In these uncertain times, it's crucial to be prepared with sound advice. Russell & Company is one of the area's premier retirement planning specialists. For a complimentary consultation, call 1-800-392-4378. Russell & Company, helping you create a winning strategy.
Welcome back. It's time for our question of the week.
This week's question comes from Fran in Pleasant Grove, Alabama. What is going on with gold? I've seen it drop quite a ways from its peak. Will it come back in the near future, or should I just give it up?
Fran, you're not alone. Everybody wants to know what's going on with gold right now here this year, when the markets have been nothing but going up and gold's been pretty much been going down for the better part of the year. Here's the reason why many people are asking about it, is they have too much invested in gold. If you're worried about it, that's a sign that you're over allocated. You have too much in gold and silver and other precious metals. I'm a big fan of precious metals, but to a very, very specific allocation. You should have no more than 5, max 10% of your total investment portfolio wrapped up into precious metals like gold and silver.
Now, the argument is that gold has never been zero. Okay. Now, people also who are fearful of world events like war or the collapse of the U.S. dollar are using gold as kind of a hedge. And it goes back to that question I mentioned earlier. Why do you own something? You got to know why you own it, before you can understand whether or not you should own it at all. So understanding that why is very critical, especially when you deal with something like gold that can be very volatile. Commodities do move very fast, and so you need to be very mindful of that, especially if you're using hard-earned retirement dollars as part of that investment.
Yeah, I mean, if you're a big fan of gold, another way to get exposure to it is through gold mining stocks, gold mining companies. I like that a little bit better because you get paid rent. When you hold gold or silver, there's no dividend, there's no interest. You just hold it and hope it goes up. But if you hold mining stocks, then they may pay a dividend, so you're getting paid rent at least while you're holding it through those volatile times. In the end, gold longer term will most likely go up because of the massive money printing we have going on here in the U.S., but there's going to be quite the roller coaster ride getting there. Absolutely.
It's great advice, Rob. And again, anything can go up and down. It's just a matter of understanding if it goes down, what's the impact going to have on you? And think about it, back to your mining stocks and all that stuff. Think about who made all the money in the gold rush. Was it the miners, or was it the people selling the jeans, the boots, the picks, and the pans? So that's very good advice, and understanding that you can hold gold in different ways. Make sure you don't have it all in one way. Don't just put it all in your garage, because then you got to hire security to guard it. So be very careful. It's a great question, though, and thank you very much for it.
Do you want your question answered on Retiring Well? Send us an email to question@retiringwell.tv.
This week on Chalk Talk, we're bringing in my favorite tax planner, Larry Flynn. He is going to share with you how taxes work with your Social Security income. Important stuff for your retirement.
Hi, Larry Flynn here. Listen, today in Chalk Talks, I want to talk to you a little bit about how your Social Security is taxed. Now, it's real important to know when I'm talking about the taxability of your Social Security, these are benefits that you're already receiving. This has nothing to do with if you're taking maybe early retirement and your income limitations that apply, completely a different thing. This is about the benefits you're receiving, how are they taxed. The first thing you're going to have to know is what's called modified adjusted gross income, or what we call MAGI. Okay, it's simply this. It's taking 1/2 the Social Security benefits you're already receiving plus all other taxable income. Okay, 1/2 your Social Security plus other taxable income. That equals your modified adjusted gross income. You then take that number, and if I'm married now and I'm filing a joint tax return, that income that's between $32,000 and $44,000 is going to be taxed 50%. Now, not taxed at 50%. I'm talking about the benefits themselves between that amount are going to be 50% taxable. And then whatever tax bracket you happen to be in is going to be the tax. That modified adjusted gross income that's above $44,000, 85% of those benefits are going to be taxable income and again taxed. Okay? But look at this, when you're single, look how these rates don't just go in half, okay? If I've got modified adjusted gross income between $25,000 and $34,000, 50% of those benefits are taxable. And those amounts that are above $34,000, well, guess what? 85% of those are taxable. We've talked about this before in previous segments, where somebody's married, enjoying these brackets, and all of a sudden they're single, and look at this. All of a sudden, more of their Social Security benefits are being taxed. And then to say the least, they're in the single tax rates, which makes even matters worse. What's not included in taxable income is municipal interest. But what's important to know is there's 3 things that are not included in taxable income. That's Roth conversions, okay? That's life insurance, if taken properly. And third would be maybe income from reverse mortgages. Okay, very important to talk to your retirement income specialist about, because if this is a considerable amount of other income is in IRAs, well, maybe a Roth conversion might make sense. Maybe life insurance to take care of the tax is important. But anyway, thank you again. I appreciate you joining me.
You're on the back 9 heading for the clubhouse. Your dreams of spending time with family and enjoying retirement are just within reach. What happens if you end up in the rough? In these uncertain times, it's crucial to be prepared with sound advice. Russell & Company is one of the area's premier retirement planning specialists. For a complimentary consultation, call 1-800-392-4378. Russell & Company, helping you create a winning strategy.
Hi, Michael Reese here, and you know what I found is in that critical period, the 5 years before retirement, all the way to the 5 years after retirement. In that 10-year period, I find that over and over again, Americans are making mistakes with their financial planning that, quite frankly, are easily avoided. And it really almost breaks my heart, because if you make little mistakes in this period of time, you can have huge consequences. So in order to help you not make those mistakes, I've put together a simple website with some free videos from me to you to help you be smart about your planning. The website is called 3mistakes.com. It's the number 3 spelled out, T-H-R-E-E, 3mistakes.com. Why don't you go there today? Hi, Michael Reese here, Certified Financial Planner and Retirement Planning Specialist. Got to ask you a question. Are you considering using annuities as part of your retirement planning? A lot of people are, they're really hot, but you don't want to make a mistake. You want to make sure you understand these very confusing tools. To help you better understand these tools, make the right decisions, I've created a website for you, makingannuitiessimple.com. It's absolutely free, a lot of great videos there. Make sure you check it out.
And now it's time for our story of the week. And Rob, I'm excited about this. You were telling me a little bit, but it coincides with something I see all of the time. I meet at least one person a week who does what you're going to share. And
This is about Bob, right?
Bob,
Okay,
yeah,
all right,
exactly.
okay.
So why don't you tell our viewers about Bob?
So, to give you a little background, Russell & Company is headquartered right by Wright-Patt Air Force Base, smack dab in the middle of a lot of engineering and consulting firms for the base. And because of that, we tend to have a lot of clients that are engineers or scientists. And Bob is one of the engineers in our local area. And Bob came to me, I think it was in 2009. He came to me and rolled over his accounts, and we worked on his strategy, his investment strategy. And Bob's a unique character, or maybe you can identify with him, because Bob subscribes to all these different investment newsletters and pays attention to all these different technical indicators like the Hindenburg Omen and different charts. And he's constantly, being the engineer he is, he's constantly trying to figure out, is there a different way to do this? Is there a better way to do it? And the problem is he's always in flux. He's always in flux. Well, here's the thing, is with Bob, his biggest issue is he is his own worst enemy. Oftentimes, engineers and scientists, you are your own worst enemies because of all the analysis that's done, and the key is not to get paralyzed by that analysis.
Well, the paralysis, analysis thing. It's the reason you do analysis is to come to some form of a conclusion. And a lot of times, if you dwell on analysis over and over, there's no action. And I'm guilty of this too. I tend to be a very mechanically minded person myself. But the one thing I have to tell myself is that, listen, the analysis must generate some level of a conclusion, some kind of a feeling that it was worth it, and you can draw that conclusion. Now, it's hard to do because we live in a 24-hour news cycle. There's always information. You could study the news 24 hours a day. And if you're a lot of people who do their own investing, in order to be good in the markets, you've got to wake up at 4 in the morning, watch the European markets open. You got to be invested all day long and paying attention to our markets. And then we have to watch the Asian markets open at night. So it takes a lot of commitment. And a lot of times when you have all this information, you got an interview on CNBC that says one thing, and then 5 minutes later, there's another interview that says the exact opposite, and you're sitting there scratching your head going, what do I do next? And sometimes there's that paralysis because of too much analysis.
Well, and that's a problem. I mean, if your goal is to maximize your return with the least amount of risk and pay the least amount of taxes, the last thing you got to be doing is taking all that data in and trying to make an informed decision. And that's why Bob hired me. Now, the interesting thing is, just to kind of bring the story full cycle, is Bob's actually taking an early retirement buyout from his employer, and now his strategy has to change, not to stay up with the latest newsletter or technical indicator, because he's got to rely on his life savings as income in retirement, because that's going to support his lifestyle for the rest of his life and his wife's life.
Yeah, and and that's exactly what we do at Russell & Company as a wealth advisor, helping people transition from that risk and growth phase to more of an income and preservation phase. It's very important. There's a big difference in investing. So that's something we can help you with. If you'd like to sit down with a wealth advisor from Russell & Company, give the number on the bottom of the screen a call. We'd be happy to sit down with you.
Every week, folks, we see another story, another example of why it's so important that you visit with a retirement planning specialist. All you have to do is call the number on the screen and we'll connect you. It's absolutely free. There's absolutely no obligation. Don't you deserve to have that rock-solid retirement plan? I believe you do. All you have to do is pick up the phone and make that call. All right, it's time to turn the page a little bit and check into another IRA blow-up. This week's IRA blow-up is a story of Herring versus Campbell. And this was a court case that was settled August 17th, 2012. Here's what happened. We've got John Hunter. He retired from Marathon Oil Company and he participated in their retirement plan, a 401k. They allowed him to name beneficiaries, and he named his wife Joyce as primary beneficiary, but he did not name a secondary beneficiary. Well, here's what happened. Joyce dies in 2004. He dies in 2005. So in other words, she died first, he didn't name any other beneficiaries, and then he died a year later. Well, the plan administrator says, well, who do I pay? There's no surviving beneficiary. So here's what the plan says. It said, well, the first thing you do is if there is a surviving spouse, pay the surviving spouse. Well, there wasn't one of those. She died. Next, surviving children. Well, John and Joyce, they didn't have any biological children, but they did have kind of adopted children, so we'll talk about that in a minute. Third, surviving parents. Fourth, brothers and sisters. 5, his estate. Well, the wife was already deceased. They did not have any biological or legally adopted children, but he did have 2 stepsons, Stephen and Michael Herring. Well, what happened, though, is the plan administrator said they're stepsons, they're not biological children, they don't count, and so the administrator ended up paying to the brothers and sisters. So, of course, the 2 boys, Stephen and Michael, sued. Now, what's interesting here is that even in his estate planning documents, he left his full estate to those 2 boys. He even referred to them as his beloved sons in his documents, but they weren't biological and they weren't fully adopted. So what happens is off they go to court for 7 years. And in the end, what happened was they lost. The money went to the brothers and sisters. His money, John Hunter's money, went not where he wanted to the boys, but to the brothers and sisters. Why? Because he didn't update his beneficiary arrangements. That's how powerful these things are. And that, $300,000 lost, is our IRA blow-up of the week. As we wrap up the show, we've got to get you the answer to that trivia question. This is a tough one this week, and the question is, September 30th, 1981, topped out the best 10-year interest rate you could get. Was it 14.65, 16.47, 17.21, or 15.84? The answer, my friends, is D as in dog, 15.84% each year for a 10-year period guaranteed. How cool was that? All right, that was our show this week. I hope you enjoyed it. Have a terrific weekend.